Good morning to you all. I wanted to thank you all for attending this morning from our Auto Paychecks team. We've got myself, John Hildebrand, and Angela Hildebrand, and Manon Jacob. We're here to discuss with our fantastic friends and partners, Dalby Wendland, with Chris West and Sarah Fisher, the tax implications and planning strategies on how we're going to deal with this, with the CARES Act that has fallen upon us all. So I would like to introduce to you our partners from Dalby. We've got Sarah Fisher, is a CPA and associate principal at Dalby Wendland and Company. She's been in public accounting for 19 years. She specializes in tax planning and tax preparation services for individuals and private companies in several industries, including auto dealerships, construction, manufacturing, medical practices, and serves as one of the firm's principal specialists in the Affordable Care Act. Chris West is the principal and CEO at Dalby Wendland. He has been in public accounting for 24 years. As CEO, he utilizes his decades of accounting experience, strategic skills, visionary talents, and people focus to grow the firm, engage and develop its people, and promote unrivaled service to their clients. He is also the firm's director of vision, which embraces a synergistic culture and high performance commitment to help Dalby's clients, people, and communities to be better. Today we have 60 minutes scheduled for both our presentation and question and answer period. Everyone will be muted during the presentation so that we can stay on track. At the end of the presentation, we'll have some time for Q&A, and it'll really help us on the Q&A if you will present your questions through the chat feature during the presentation, and Manon will keep up with those, and we'll try to get as many of those answered as possible. If you'll do us a favor and make sure that that our sound is coming through correctly and clearly, if one or two of you could chat and say, hey, we can hear you, that really gives us some peace of mind in today's world here. And then if we don't get to your questions, please know that the PowerPoint itself and the recording will be redistributed to all attendees, and it will also be posted on autopaychecks.com under our blog section. And at this point, I'd like to turn this over to Chris and Sarah, and thank you all for attending.
Thank you, John. It is certainly a pleasure to be with all of you today, and thank you to Auto Paychecks for hosting the whole webinar series and hosting us today. Tomorrow is April 15th. It is really strange to think about. In my 24 years, this will certainly be the most unusual April 15th that I've gone through, and probably safe to say for a lot of CPAs out there in the world. We're going to kick this off really quickly, and Sarah is going to walk us through the presentation, and I'll add some comments as we move through. And as John mentioned, this is a legislation that's happening very quickly. It's large legislation. The landscape is moving and changing daily still, and will continue to. So it's challenging to do a presentation like this and give any type of certainty. So there's still questions that are unanswered, and guidance and Q&As that are coming out daily. We sat through a webinar last Friday with a national speaker. That webinar presenter probably was just getting up to speed himself for that webinar to us, and so it is certainly a fire drill of getting up to speed for a lot of professionals across the country. And we appreciate your patience in kind of digesting this with us today. And I'd like to introduce Sarah. Sarah is part of a team that we've established at Dalby Wendland and Company, task force relating to COVID response and getting up to speed with this fast-moving legislation and various aspects of it. And Sarah's been instrumental on the team in helping Dalby be proactive with our clients and trying to get information out to our communities and to our people. So with that, want to get started. Sarah, please take it away.
All right. Well, thanks again for joining us. I hope this finds all of you and your families healthy in this crazy time we're living in. And again, today, I'm going to discuss and review the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, and IRS tax relief that has come out recently with different tax provisions for both businesses and individuals. All right, so high level, of course, tax return deadlines are extended July 15th. Some individual provisions to take a look at today are the stimulus relief payments, those rebate checks. And for individuals, there's been some temporary relaxation of the rules on retirement plan distributions. Business provisions, employer payroll tax incentives, we're going to take a look at those. Net operating losses and loss limitations have been expanded to allow for more deductions in that regard. Qualified improvement property, there's been some favorable adjustments to the depreciation rules here for business owners. One thing I want to mention that's not on the slide here is, in addition, the CARES Act provides the Small Business Administration, the SBA, different disaster loan assistance programs, and I'm sure all of you have heard about the PPP loan, the Payroll Protection Program. Timberline did a great presentation last week and went into that. We're not going to be discussing these disaster loan provision programs today, other than how they impact some of the payroll tax incentives that we're going to talk about. I do want to mention, however, before we move on, in regard to the PPP loan forgiveness, this is a common question that's been coming up. When you go through those calculations for the portion of that PPP loan that's going to be forgiven, this is going to be a tax-free item. So it's not going to create taxable income like debt forgiveness typically would, and that is written in the CARES Act. So that's all I want to mention in that regard. And then finally, the IRS is temporarily halting most of their enforcement and collection actions from April 1st to July 15th. And I want to emphasize the word temporarily because I have heard some rumors of people thinking that they didn't have to pay some of their back taxes that are in existence. So what this is that existing installment agreements where you've set up a payment plan with the IRS, you can suspend those payments without the IRS coming after you. You still owe that balance and interest is still going to accrue, but you can temporarily postpone those payments. Another thing here, liens and levies are being temporarily suspended through July 15th, and different field, office, and correspondence audits that the IRS may be working on for taxpayers will be postponed until after July 15th. Okay, so of course, this is the first thing we're going to talk about is the fact that April 15th is essentially July 15th now, filing and payment for tax returns. The following list here are now due July 15th, and again, there's no filing of an extension form tomorrow. There is no payment to remit tomorrow. If you cannot file by July 15th, you are at that time going to need to request an extension. So again, this is federal income tax returns and payments, individuals, corporations, estates, and trusts. This also pertains to self-employment taxes, first and second quarter 2020 estimated tax payments, gift tax and returns, estate and generation skipping tax and returns, and in addition, health savings account and IRA contributions. If you have not yet maxed those out, you can do that now by July 15th and get that deduction on your 2019 tax return.
Just going to interject, Sarah, that's a good list, and I kind of think of this provision in the law as should be dubbed the no summer vacation for accountants provision. So unfortunately, we're thankful for the extra time, but it's going to certainly drag things out on our end, but we'll survive. And And on last Thursday, the IRS came out with another notice that really expanded a lot of the deadlines. There were questions about a lot of other little deadlines and things that might be coming up during this time that are tax related. And that notice essentially tried to expand or delay almost every imaginable deadline. And we're not going to go into all of those beyond what Sarah just listed here. Sarah listed the important ones, and I wanted to emphasize the IRA contribution and HSA contribution. Very popular deductions that are typical to fund for the prior year being 2019. Typically, you do that by April 15th to get it deducted on your 2019 return. And just want to emphasize that you have now until July 15th to fund those HSA and IRA contributions and get it deducted on the 2019 return. And just, I wanted to mention 3 things that came out in the notice last week that some time-sensitive things, if you are in process of doing a 1031 exchange, some taxpayers in real estate might be executing a 1031 exchange. That process has time-sensitive dates to it, things that have to be done at a certain time. If those dates were falling between April 1st and July 15th, the date gets automatically removed now to July 15th. The same for any opportunity zone funding. That has a time frame to it too. Opportunity zones have been a popular thing, especially around here in Mesa County. If you're trying to fund an opportunity zone and you're trying to meet the 180-day rule and that deadline was coming in between April 1st and July 15th, that automatically gets moved to July 15th. So those are just 2 examples of a few things in this expanded notice that came out last Thursday, trying to encompass everything that might be due between April 1st and July 15th. Certainly with the exception being, and it's worth noting, payroll tax forms 941, are not part of this and are still due as normal, as scheduled, on the normal filing schedule. So
That's right.
payroll tax forms still need to be filed. Go ahead, Sarah.
So just a quick note, as kind of an overarching comment on this. As with Michael Santos' first talk to his second talk, there were significant changes as it affected employment law. You guys are trying to stay up with the best information today that we have, but we can expect this information to change at some level.
Yeah.
So really keep your eyes peeled and stay in touch with whoever your accounting professional is. If you don't have one, these guys are great, but we do expect this to change. It is a moving target because this legislation is so big and it came out so fast.
Correct.
That's right.
So just as a rule of thumb, as we talk about this, everybody's going to need to stay up to date on this because it is going to change.
Yep.
This is the best information we have today.
It's a moving landscape right now, and so we have to balance ourselves and be ready for change.
And our quarterlies, 941s, will be out 100% by the end of this week.
Good.
All right. Good job. All right, let's talk about the first individual provision of the CARES Act, and that would be those rebate checks, the stimulus relief payments. This is what is going out in the mail this week, is what I understand. The IRS is going to start doing this. Individuals are going to receive a tax credit, a check of $1,200 for single, $2,400 for joint filers, plus $500 for each child under the age of 17. There's a phase out that begins for taxpayers with adjusted gross income that for a single individual, $75,000, and $150,000 for joint filers. For filers with income above those amounts, the payment that they're going to receive is reduced by $5 for each $100 over those thresholds. Single filers with income exceeding $99,000 will not get any check, and $198,000 for joint filers, they will not receive a payment either. So an example, a married filing joint couple who are underneath these AGI limits, 2 kids under 17, they would get a check for $3,400. This is not available to non-resident aliens or individuals who can be claimed as a dependent by another taxpayer or estates and trusts. These rebates are being treated as an advance refund of on your 2020 tax return. So this is not going to be included in your taxable income. The calculation, the numbers that the IRS is going to use is going to be based on 2019 returns, if they're filed. If they're not yet filed, they're going to use 2018 tax return information. There's some exceptions. There's some individuals whose income is so low that they may not have had to file a 2019 or 18 tax return, in particular Social Security recipients. If those individuals, those senior citizens, lower income disabled, did not file tax returns, the IRS is automatically going to pay those individuals. For anyone else whose income was so low that they didn't file a tax return, they're going to have to go onto irs.gov and file a simple tax return / register with the IRS in order to get a rebate check. The payments are set up to direct deposit based on the information that was in your prior year tax return. And if that information is not the information you want the IRS to use, you have to go to irs.gov and notify of the change. The IRS is going to be notifying individuals of these payments within 15 days, and they will send a letter in the mail to you. My final comment on all of this is to avoid scammers. Reminder to everyone that the IRS is not going to call or email you in regard to these payments. And so if you get an email or a phone call trying to confirm your information, just beware.
Okay, very excellent point, excellent
All
point.
right?
Yeah.
We did have one question come
Yeah.
in. Peggy asks, are rebates available for SSI or SSDI recipients who don't file?
Social Security recipients, yes. They're going to automatically get those payments. The IRS will send those out. They don't have to take any additional action. Okay?
Thank you.
All right, so another provision for individual taxpayers under the CARES Act is some relaxation of retirement plan distributions. There's no early distribution penalty. That's the 10% penalty for an early distribution from your qualified retirement plan. If you're under 59 and a half, for a coronavirus-related distribution, up to $100,000 until December 31st. There will not be a 10% early distribution penalty on these type of distributions. You can then roll over this coronavirus-related distribution or put the money back, that's what the rollover is, within 3 years of this distribution, and you will not have to pay income tax. If you do not roll over or put the money back into those retirement plans, then the income tax on the distribution can be spread over 3 years, starting with year 2020.
And Sarah, what is a coronavirus-related distribution?
It's pretty much anything, but there's a laundry list of, I can rattle them off here. Let's see. If you were diagnosed with the virus, if your spouse or dependent was diagnosed with the virus, if you experience adverse financial consequences as a result of being quarantined or furloughed, laid off, or having your work hours reduced, or let's see, if you were unable to work due to lack of child care, that qualifies as a coronavirus-related distribution. Closing or reducing hours of business owned or operated due to the virus. And then the final is other factors determined by the IRS. So those are the
Pretty flexible.
yeah, so, okay. And then let's see, the other things in regard to retirement plans in the CARE Act is individuals may borrow up to 100% of vested account balances, up to $100,000, and existing loans of up to $100,000 from qualified plans, and repayment can be delayed for 1 year. And the final point here is that required minimum distributions, those are the required money that you have to take out of your retirement accounts when you hit 72 in 2020 or 70 and a half for 2019. These RMDs are temporarily suspended, meaning you don't have to take the money out. And if you have already taken an RMD, you're allowed to put the money back in via an eligible rollover.
I was going to interject a few things from Sarah's comments, and lastly there you talked about the RMDs, and I think this is a nice provision. It allows those that are currently required to take distributions who would normally have to sell, possibly have to sell assets, sell investments in their IRA in order to create the liquidity to make a distribution. Now we're not going to be required to sell, and it's not a good time to sell right now in the market, as the market is down. And so this could be a nice benefit for those that are taking RMDs that don't otherwise have to take it to delay taking that distribution. Then I wanted to just make a general comment about these rules, and I'm kind of getting on maybe a soapbox a little bit, something I'm passionate about, which is retirement planning. And I certainly would caution those that are considering taking a retirement plan, either loan or distribution out under these provisions. Try to make it a plan B or a plan C in your personal budgeting. Really think hard during this time about your family budgeting and what could be cut, what could be saved, or cutting back on this and that. And certainly not going to go into a detailed discussion there, but I strongly believe that those retirement plan assets are there for retirement, and so if you can do anything within the realm of possibility to either not have to draw or not draw as much, it would be ideal. And then, of course, just a quick note out to employers and companies that are sponsoring 401k plans. This may be a time to check with your advisors, your TPAs, your plan advisors on changes to your plan document that may be necessary to account for and include some of these new provisions. That's just something to think about and to talk with your 401k advisors about.
Good point.
Quick question from Cliff. If you have an installment plan with the IRS, do you have to file anything special on your payment suspended until July 15th, or to not your stimulus relief payment to be applied to your back tax debt?
I am not aware that you could apply your stimulus payment to it, and I don't think you have to make the installment payments, but it might not be a bad idea to confirm, and interest is still going to accrue regardless. All right, so a handful of additional things on individual provisions that I want to mention briefly here. The CARES Act allows for the AGI limitations for itemizing your charitable contributions for 2020 to be increased to 100%. And what this is typically taxpayers are limited to a charitable deduction when they itemize of up to 60% of their adjusted gross income, and anything in excess of that is carried forward to future years. The CARES Act temporarily removes this limitation, and you could itemize and take a charitable donation up to 100% of your adjusted gross income, and that's for people who itemize. And then second, there's now going to be, just for 2020 and above the line, $300 charitable deduction for cash donations in the year 2020 for taxpayers who don't itemize. And then student loans paid by employers, the Act provides an exclusion up to $5,250 from income for payments of an employee education loan. Okay, so moving on to the business provisions now. First, we're going to talk about the employer payroll incentives that are part of the CARES Act, the employee retention credit, and the employer payroll tax deferrals. And the Families First Coronavirus Response Act, the FFCRA, has payroll credits for that required sick and family leave. One quick point I want to mention here is that all of these are available only to the common law employer, not the third-party payer.
Can you explain what that means, please?
You probably can explain better what that means.
No, I'm gonna let you do that here, so.
So I guess that means who the actual employer is by law, not just who is maybe paying their payroll. If you had
Like a
how
P-
to
like a
explain it,
PEO,
like
like a PEO relationship, or,
Right.
a management company.
right. So it would still be the employer, the statutory employer, and maybe that delves into a legal question
Yeah.
that getting attorneys involved into, but, it's the statutory
The
employer,
common
not,
law
not the
employer.
PEO.
Right,
Mhm.
I've never heard it called a common law
Oh.
employer before, that's a new term to me.
Oh.
That's a
Yeah.
brand new one. So, and one of the questions that came up, while Michael Santo was here, was what about my 1099s? My contractors that we regularly use, there were
Mhm.
questions about being able to apply for some of these loans related to 1099s, and the answer is no.
Mhm.
They have to apply themselves as self-employed people for the loan, which they can do, but because they are not your employees, you cannot apply for or get any credits for independent contractors.
Correct. This employee retention credit is payroll.
Right.
It is your payroll.
Your employees.
Yes, mhm.
And we
Reported on 941s and
Yes,
W-2s.
because sometimes, and it's just lack of experience, we've had people come in and talk to us about payroll and say, all my employees are independent contractors.
Right.
And you can't use those two terms in the same sentence.
No.
So just make sure that you separate those out correctly.
Right. So the first payroll incentive under the CARE Act is this employee retention credit. And it's a refundable payroll tax credit, and it's capped at $5,000 per employee. The calculation is 50% of eligible wages, and we'll go into that a little bit, up to $10,000 per employee. So that's how you get the $5,000 per employee, paid by an eligible employer, and we'll talk about that in a minute, to its employees between the period of March 13th, 2020, and December 31st. So just a couple quick examples to illustrate. If an employee earned $8,000 in quarter 2 and $8,000 in quarter 3, the eligible credit is $4,000 in quarter 2 and $1,000 in quarter 3. That equals $5,000, so there's no more credit eligible for that employee. If an employee earned $7,000 between March 13th and December 31st, the total credit available would be $3,500, 50% of $7,000. The credits are claimed via reduction of the 941 payroll tax deposit, or the IRS can advance the credit payment to eligible employers if it is above and beyond that 941 via the Form 7200. Something I want to point out too before we move on is if the employer is a taxable entity, the amount of the credit that they receive back, the refundable credit, is going to be taxable income to them. So the net benefit needs to be, of the credits is reduced by your marginal tax rate. You got to think of it that way.
So a couple questions came in, just to clarify, can this retention tax credit be used with the PP loan?
Right, and that was the last couple points I want to mention here. You cannot take advantage of this credit if you are taking out that small business interruption loan, the PPP, the Paycheck Protection Loan. And another thing is you cannot use wages for this credit if the employer is going to be receiving credit paid under that family and sick leave under FFCRA. My word of caution is if you're in the process of getting the PPP loan is to proceed with caution in getting these employee retention credits. I think clarification is still coming out as far as how those PPP loans are going to be forgiven. So I would be careful is what my advice would be, so that you don't jeopardize any of your potential forgiveness on those PPP loans.
Right, because some of the language looks like
Yeah,
you could have it all,
correct.
but as you read it and as we look at precedent,
Mhm.
that's virtually never allowed.
No, in the
You could
spirit,
double dip
right.
like that.
Yeah, the spirit of all of this is not so you can double dip.
Right.
If you're going to take advantage of that PPP program, which is, the intention of that is the SBA is giving the banks money to give to you so you can cover your payroll costs, you wouldn't also then be eligible to take this employee retention credit, because that's
Right.
double dipping, like you
Right,
said.
and I think it would be fair to say that tax professionals are pretty leery of some of the wording right now because
Right.
it hasn't settled.
It hasn't, and in fact, as of today, I don't believe there's guidance from Treasury or SBA in how the PPP forgiveness is going to be actually computed.
Yeah, in fact, it's been very, very clear from the SBA that they're, in the webinar we sat through on Friday, that there is still more guidance on the forgiveness piece that's coming out. So we kind of have an idea of the formula and how it should work on the forgiveness side, but there's still a lot of unanswered questions that we expect to, hope to get answered sooner rather than later on how the forgiveness will work. I will interject that it seems like there is a hard and fast rule. You do the PPP, you cannot do the employer credit. And absent some guidance that will come out, we're kind of, that's the rule as we understand it.
Right.
And so it would behoove employers to do an analysis if you're thinking about what is better. Generally speaking, and I'll emphasize the word generally here, I think most businesses will find that a PPP loan, which is a tax-free forgivable loan, is probably going to pencil out better than the employer credit. However, you need to run your numbers and your specific circumstances to see if that is in fact true. So just a word of caution there that it's worth an analysis, kind of a cost benefit or a what looks better type of analysis between the employer credit and the PPP.
Yeah, I'm gonna say that these, even for small employers, these loans add up to tens of thousands, if not hundreds of thousands of dollars. And if you don't, we know a lot of small businesses that do not have a CPA to consult with. This is a lot of money with a lot of liability around it. If you don't have a CPA, someone who really has studied this, get one, because this is a lot of liability. It's a lot of money you're taking in that you're responsible for, and if you do it wrong, it's a lot of money.
Yeah, get good advice. And
get good advice.
And full disclosure, we didn't just pay John for that free advertising.
No, and we recognize that not everybody listening is a Dalby client.
Yep,
exactly. But get really good advice from a true professional, because this is a lot of money.
Yeah. Surround yourself with a good advisory team.
Yes.
Okay, so a little bit more information on these employee retention credits. Eligible employers are businesses whose operations were fully or partially suspended in calendar quarter due to the COVID-related shutdown orders, or 2, declined in gross receipts in a 2020 calendar quarter by more than 50% compared to the same quarter in 2019. The definition of the qualified wages used in the calculation is different depending on if the employer has 100 or less full-time equivalents or more than 100. Essentially, if you have more than 100, the calculation is a little bit different in that employees who are working remotely, they're not eligible for the credit, those wages. And then for employers with less than 100 FTEs, all wages paid in that time frame qualify for the credit. Okay?
And, maybe one other point here is the whole purpose of these loans is that you keep your people employed.
Right, absolutely.
So, we have a client, not to mention their name, but they have 100 and some employees. They are closed because of the nature of their business. They cannot work. They got the loan, and they are remodeling the interior of their buildings. They are sprucing up. They are keeping people employed, because that's what this money's for.
That's exactly what it's
So
for.
it's not to put it in employer's pocket, it's not to give a holiday, it is to keep people's mortgage pays and groceries and car payments. That's the spirit of this, so stay with it.
Right. So that's the employer retention credit. The other employer tax incentive under the CARES Act is the ability to defer your payroll taxes. Employers can choose to defer payment of the employer's share of Social Security taxes due on wages paid from the enactment date, March 27th through December 31st. And the self-employed individuals can also defer an employer FICA portion of their SE taxes for the same time period. The 2-year deferral of payment, the first half is going to be due December 31st, 2021, and the second half, December 31st, 2022. It's important to note that you cannot elect to defer your employer payroll taxes again if you take out that Paycheck Protection forgivable loan and you receive forgiveness on that debt. Okay, so moving on, as Michael Santos talked to you guys about, if you participated in that webinar, the Families First Coronavirus Response Act, FFCRA, has created some required sick and family leave pay for employers of less than 500 employees affected by COVID-19. And as part of the FFCRA, there's payroll credits if you're an eligible employer. You may elect to receive a refundable credit in the full amount of the required sick and family leave pay under these new FFCRA rules. Eligible self-employed individuals also qualify for comparable credits against their self-employment tax. However, make note that there's no double benefit for those who are both employee and self-employed. This is effective for April 1st through December 31st, 2020, and the mechanics are a reduction of employment tax deposits claimed by reducing those 941s by the gross wages, Medicare, and prorated employer portion of health insurance and retirement costs. And if the total FFCRA payroll costs exceeds the 941, you may use Form 7200 to get the excess refunded. There's no restrictions to take these credits if you have a small business loan. However, caution is make note that PPP loan forgiveness, these particular FFCR payroll credits taken, those wages would be carved out of your loan forgiveness. So another item to proceed with caution, and this is something we still don't have a lot of clarity on, and that is why you may not want to elect to take these credits on these types of pay. So required sick and family leave under FFCRA. The FFCRA expands and adds required family and emergency medical leave pay for those certain employers who have less than 500 employees. I'm going to review the required pay and the subsequent credits here. I'm not going to go into detail on what and when an employer is required to pay. I think Michael Santo did a good job talking about that. What I'm going to emphasize here is what the FFCRA says you are required to pay them, and thus what's eligible for that 100% credit. Under the FFCRA, there are 6 reasons for paid sick and family leave for which an employee may be unable to work or unable to telework due to need of leave. And those are: 1, they're subject to the federal, state, local quarantine or isolation order. 2, they've been advised by a healthcare provider to self-quarantine. 3, they're experiencing COVID symptoms and seeking diagnosis. 4, they're caring for an individual subject in one of 1 or 2's orders described. 5, they're caring for a child whose school or place of care is closed for reasons related to COVID. Or 6, they're experiencing any other substantially similar conditions specified. So now that we know those 6 reasons, the amount of pay and the duration of leave varies depending on those above mentioned 6 reasons. So first, the duration of leave that's required to be paid and thus eligible for the credit for reasons 1 through 4, and those were the reasons that someone was quarantined or sick, experienced symptoms, or caring for someone with those. Basically everything except for if your school is closed. For reasons 1 through 4 and 6, for full-time employees, the maximum of 10 days or 80 hours is eligible for the required pay and thus the credit. For part-time employees in these reasons 1 through 4 and 6, it's the average hours of the 2-week period, and I've been not quite sure how to calculate this, but the Department of Labor has a really good FAQ that goes through some examples, and I've made note of that here. Okay, so then for reason 5, that is caring for a child whose school or place of care is closed. For reason 5, the employee is eligible for up to 10 weeks of leave at either 40 hours a week, full-time, or if they're a part-time employee, the average hours a week. Something else to note here I want to mention is that the family leave payment here, it's not required for the first 10 days that they're gone. And another thing to understand about the duration of leave is that all leave hours weeks are cumulative. So once an employee hits their limit, they do not get additional FFCRA leave. So once you understand the duration of leave for your particular employee's circumstances, the calculation of pay that's required for those employees varies, again, depending on the reason. So for reasons 1, 2, or 3, the employee gets their regular rate of pay, not less than minimum wage, with a max required of $511 a day, times 10, that's the duration that's required, would be the $5,110 per employee for those reasons. For reasons 4, 5, or 6, the employee gets 2/3 their regular rate of pay with a max of $200 a day. So again, those durations are 10 days, so that times 10 is 2,000 max per employee for those reasons, 4 and 6. For reason 5, that's the longer duration, right? Reason 5 is if your school is out. Those employees are eligible for the $200 a day for that whole duration of the 10 weeks. And that max is at $10,000 for reason 5 of extended leave, okay? So let's see, what else did I want to mention here?
And on the extended leave
Yes.
per school, how much of that is creditable or
The max amount that they're required to pay
right?
is eligible for the 100%.
Right.
Yeah, so again, the mechanics of that would reduce your 941, and then if it goes above and beyond your 941, you can use that Form 7200.
And you can extend that crediting over how long? Depending on how much your liabilities are for that 941 as an employer?
Right. Is that what you're asking?
Yeah, how
If
long
it goes,
can you extend that
well, it just,
to recover those funds?
I guess I don't understand your question.
So if the say the $10,000 is more than the next 2 quarters' liability is, how long can I?
Oh, I think the Form
Can I-
7200,
Right,
you would get it refunded. You would apply,
Mhm.
you
Very
would
good.
fill out the
Okay.
Form 7200, and you would say, this much was greater than my 941, and I want the IRS to refund it to me. And they would write you a check.
Okay.
I think what you're saying is if you choose not to do that, then you would apply it to your next quarter.
yeah, depending on what on how much you had paid as
Correct.
a liability.
Yeah.
So on the part-time employees, a lot of these wage figures could be figured on an annual report for the previous year. A lot of people are doing a 2019, January 1 to December 31st to figure wages to get the PPP loan.
Right.
And you can use, depending on the system that you track payroll on, you should be able to run a report for average hours worked for an employee in the different categories and then base that leave
Right.
on that.
If you're filling out a PPP loan
Well, for this sick leave,
for calculating those.
for the part-timers, right?
Yeah, that makes sense.
We also have a question from Wendy. I understood that you could use the sick leave to cover the first 10 days of the family leave, is that correct?
I believe so, yes.
Thank you.
All right, anything else? Okay, I'm talking too much. Okay, these next 3 slides are just a summary of what we just talked about. I don't know about you, but I find it very confusing to keep all of these straight. And I found this really nice chart credit given to an article from Plant Moran, and it compares all of the different, credits that we just talked about, and
Great.
the different requirements and thresholds. So I'm not gonna go into all of that here. And it tells you if you can or cannot use them, if you're getting the PPP loan. The only thing I wanted before I move on to the next section is that exempt entities are eligible for these credits, 501Cs. However, federal and state and local government agencies are only eligible to use the payroll tax deferral incentive. They're not eligible for anything else, okay? So now, moving on, net operating loss changes, NOLs. In 2018, the Tax Cuts and Jobs Act, TCJA, eliminated the ability to carry back net operating losses to prior year tax returns and recover taxes paid. So for losses arising in tax years 18, 19, and 20, the CARES Act has a 5-year carryback is now allowed to help businesses recoup some of those prior year taxes. Another thing that the CARES Act has done is they removed the 80% limitation of taxable income that is under TCJA rules, and now allows the NOL to fully offset taxpayers' taxable income for years 18, 19, 20. So as you can see, you may need to amend tax returns to get this benefit, and maybe even considering other opportunities to maximize losses and carry back.
I'll just emphasize on this slide too, this is one of those takeaways out of this presentation I think is important, and this is a cash in your pocket type provision. If you were in a situation where you had a net operating loss on your 2018 tax return, it was probably limited, you weren't allowed to carry it back. You are now allowed to carry it back, and so amending the return to carry back and get taxes back for the last 5 years is a possible cash in your pocket soon provision that should be taken advantage of. So I wanted to emphasize that this is something to be talking to your advisory team about if it applies to you.
Right. Okay, another part of the Tax Cuts and Jobs Act back in 2018 was they put limits on excess business losses and limited the amount taxpayers could deduct in a given year. The CARES Act retroactively postpones the effective date of the excess business loss limitation to taxable years beginning after 2020. So the cap on the deduction for these business losses for individual returns is suspended. Under Tax Cuts and Jobs Act, that amount of business losses over $500,000 for married joint and $250,000 for single was non-deductible, and excess had to be carried forward to future years. And this act suspends this limitation rule for 18 through 2020. Another opportunity to amend tax returns. Another thing is the CARES Act for qualified improvement property. They made a technical correction to the Tax Cuts and Jobs Act again to allow these types of real estate improvements, which would be non-residential property, building improvements to interiors of buildings, okay? So if a business has put into place these kinds of asset additions, under the old rules with TCJA, this was a 39-year asset, and you had to spread out the deduction over 39 years. The CARES Act makes a technical correction to the TCJA and allows you to depreciate these types of property over 15 years. And what that also does is makes these improvements eligible to use bonus depreciation under 168K so that you can write it off even more immediately.
So this is another item to emphasize Sarah's talking about. This is another one of those takeaways and cash in your pocket type provisions that if you are a real estate owner and you have been improving real estate and had some improvements in 2018 and you might have got stuck with this technical error that happened in TCJA and you're sitting there with 39-year depreciation on your current depreciation schedule. That has now been fixed, and so amending, and it either involves an amendment or a 3115, a change of accounting method type of filing. Talk to your advisors about how to do that and if it applies to you, but this could be the difference between writing off those types of assets over 39 years
Mhm.
versus writing off all at once and getting cash back
Right,
in your pocket, much needed cash back now.
right,
So
right,
certainly be wary.
right. And that change was made as effective with the Tax Cuts and Jobs Act, so for property placed in service after September 27th, 2017. If you had those kind of improvements, they would be an opportunity, like Chris said, to amend tax filings. Okay, there's just a few more miscellaneous business provisions in the CARES Act that I wanted to mention. Retirement plans, the bill gives pension funding relief for failures to meet contribution requirements during 2020. Minimum tax credits, this is for regular C Corps. The bill accelerates the year for which a fully refundable credit can be claimed to 2019. So then this allows corps to elect to claim a fully refundable minimum tax credit in 2018. Business interest limitations, this is only applicable to large businesses with gross revenue over 25 million, but part of the Tax Cuts and Jobs Act limited the amount these types of businesses could deduct in interest, and the CARES Act expands that interest limitation. Health plans, the rules of high deductible health plans are amended to allow them to cover telehealth and remote care services without charging a deductible. And finally, charitable deductions for regular C Corps. The taxable income limit on those charitable gifts rises to 25% for 2020, up from 10%. Okay. Phew.
Good job, Sarah.
Yeah.
So, I wanna say my head hurts a little bit.
Mine does.
So, this is, I'm gonna emphasize this again, is if you own a business and you do not have a tax professional, a CPA, who has done their homework on this, you need to get one, because there's so much money at stake on this. And most people's businesses are under exceptional stress at this point. It's, there's very few businesses that aren't. So take advantage of that, find one, and get their advice. We will be hosting another webinar with Timberline to talk about the forgiveness around the PPP and the rules around that as they begin to settle. They are not settled yet, so we're not ready to do it yet. I want to see what kind of questions we have that we have not yet. I'm sure there's some that we won't get to. We've got just a few minutes left here, so.
Yeah, I'll just start at the top of the list if that's okay. One of the first questions we received was from Lainey, and it's on the PPP loan. Can you go back into March to draw off this loan as it relates to COVID-19 payroll?
So my understanding is no, to give you a short answer there. And I assume the question relates to the forgiveness aspect
The calculation
of
of
the
the
loan.
forgiveness.
And so it seems pretty clear that only expenditures after the loan funding.
Yes.
So if your loan funded today, it would be qualified expenditures such as payroll, et cetera, between now and the next 8 weeks.
Thank you. And then Jeremy had a question. You referred to an advanced refund for the stimulus check that's coming out.
Oh, for the individuals?
Does that mean that this is really a loan against your 2020 return?
No, it's not income. This is a credit that's going to be on 2020 tax returns, and the IRS is simply paying them now. That's the advance.
Okay.
I will say that it's a little unclear yet on, this is one of those where the mechanics of it are still to come out. It seems clear that you're getting an advance payment based on your 2019 return. If 19 isn't filed, it's based on 18, but ultimately it is based on your 19 on return is what it seems like. And so on your 2020 return, as you account for this credit,
You may be truing it up,
you
if
may
you
be
will.
truing it up on that 2020 return and not getting the full benefit if your 2019 income was higher than your 18 per se.
Right.
So those are just things rolling around in my mind. We haven't seen all the mechanics of how that's going to work yet.
So that could be an instance where you may have to pay it back.
May have to pay some back.
So,
If you were advanced based on your 18, your 18 was low and your 19 was high, and you eventually filed your 19, but you received the advance credit based on your 18, that could true up on your 2020 return.
So to be clear, this $1,200 per individual isn't just free money, it's an advance.
It's an advance on a credit,
Right.
on your 2020 return. Mm-hmm.
The credit to be calculated on the 2020 return, if for some reason
Right.
you don't get that credit.
Right,
You might get it though,
yeah.
if you were eligible based on the way you file on your
Yeah.
tax return, you may get it.
So we had a couple questions about SSDI and Social Security.
Yes,
So those people really don't have a liability on their, or much of a liability on their tax return,
mm-hmm.
so they don't really have anything to credit it against.
They should have no problem with the,
I would think so, but that, wouldn't be surprised if that becomes a question.
yeah.
I don't think the government's gonna go asking them for that money back at this point, but again, there's a lot that's up in the air right now. So,
Lisa asked the question, through auto paychecks, is the credit against our payroll deposits automatically done, or do we need to request it? And I can answer that one. You will need to request it because of the PPP and the tax piece, how they, work. We don't want to remove anybody's ability to qualify for the fully forgiveness piece of the PPP. So if you want the tax credit, you do need to contact us, and we have a form that you can sign and get back to us. Leanne asked, employer payroll taxes are not something the PPP is covering from the original guidelines, only payroll, rent, and utilities, correct? How are we supposed to cover those payroll taxes when we've been shut down for 6 weeks?
That's a good question. Payroll taxes are not part of, you know, the eligible expenditures, if I understood right.
But
Sarah,
I
on
think
the
your gross
PPP.
payroll is.
Your gross
So
payroll.
what wouldn't be covered then was the employer's
Employer
share.
share, yeah.
Mhm.
And that can be deferred, can it not?
Not if you're getting forgiveness under the
Okay.
PPP.
So I think
Yeah.
she's identified a, you know, just a challenge, a problem, that you still cover your employer payroll tax.
Mm-hmm.
And then we had some clarifying questions around the FMLA and how this emergency FMLA plan works with the original FMLA. Can you, if somebody's already used FMLA, can they also use this?
And we're gonna defer probably
Yeah,
to
that's-
Michael Santo on that, not being labor attorney.
Labor law
I-
questions, labor law questions.
We agree,
yeah.
go talk to Michael or your, whoever your, and again, this is another time. If you don't have advisors, real professional advisors in your world, and you're taking $100,000 in tax credits and you're paying out, you really, really, really need to be solid on how to deal with this money.
Yeah.
It is a lot of money, even for small businesses that have 8, 10 employees.
And I do remember Michael addressing that question in his most recent webinar, so you can go back and do the recording of that on autopaycheck.com on our blog. So that's a great question that we've seen several times. I have a question from Rachel. Should you file a $7,200 each quarter for the amount above your 941 credit, or do you carry it forward?
I think that that's, up to your discretion. I think that's the reason they created the ability to do it on the 7,200 is if cash flow reasons you need that money, then the IRS has created a method for you to get that cash in hand faster, right? By filling out the 7,200 and getting the money now rather than carrying forward the credit on your 941.
Thanks. And I think one last question. This is from Heather. Can you fund a college saving account for 2019 anytime up to July 15th?
It's my college savings account, and that's a great question. If we're talking about a 529 plan, let's talk about the 529 plan variety. Let's think that through. You know, you don't normally have a federal deduction for a 529 plan contribution. So there's really no deadline for that contribution to get any type of federal credit. You can certainly make a contribution to the 529 plan. Maybe she's thinking about the Colorado deduction that was allowed, and at the moment it escapes me on whether you can make that contribution by April 15th.
After the year end,
Yeah, and
I'm
still get
thinking you
Colorado.
can.
Yeah.
I'm not sure. on that question.
That-
I thought you had to make it within a year to get
Within the
the
year, that's
Colorado
what
credit.
sticks in my mind at the moment, I'm just not drawing it out of my feeble little brain, but, these extension of deadlines that we're talking about are federal. The
Mhm.
state has essentially gone along with what federal has done, the state of Colorado. But my recollection of 529 plan funding, even for the Colorado deductions, you
Right.
had to fund it in the calendar year you're claiming the deduction.
Cash basis, yeah.
Yeah.
Mhm.
And sorry, I know I said that was the last question, but I do have one more quick one. Brandy asked, who does the PPP audit? Do you know if it's gonna be the bank or the accountant at this point?
Well, you use the term audit, and that's a good question. I don't know if this is really gonna go through a true audit process. Those rules are, I think we said at the beginning, SBA is coming out with guidelines as to how the forgiveness phase of this will work. And that's a good question to end on, just to say as well. I think over these next 8 weeks, or 8 to 12 weeks,
Mhm.
whatever it is, during the period between loan funding and forgiveness, is to be very proactive with your advisory team and be thinking about the rules that are coming out
Yeah.
and how to plan your expenditures to make sure that you're rock solid on getting as much loan forgiveness, if not all of it, forgiven as possible. I'm not aware that there's gonna be an audit, like a third-party, independent type of audit of these things. I have not seen
I
that,
haven't either.
and I would hope that there would not be.
I
but-
envision it's to the discretion of the banks on
Yeah.
how they're going to verify those expenditures
Yeah.
and how they qualified. The banks will be using SBA guidelines on what
Yeah.
qualifies as eligible for forgiveness, and then using that to their discretion as to how much they're gonna want to verify, what kind of supporting documentation.
That's a great segue to stay tuned.
Yeah, more to come,
Stay
right?
tuned from Timberline
Yeah.
on that. So I want to just reflect on how much time and effort it took to put this presentation together. Thank you so much, Sarah and Chris, for doing this work. It's incredibly valuable information, so huge thank you to you both and to your team. I know you're not the only ones that worked on this, so the time went by fast. It was the kind of a fire hose treatment as far as the amount of information that was presented. So we will distribute a recording of this to everyone who was in attendance, and it will be posted on allpaychecks.com on our blog. I want to thank you so much to all of our attendees for taking time out of your busy days to be with us. If we can help in any way, please call us directly at Auto Paychecks. And again, we said it again and again and again, if you don't have advisors during this time, you need them if you're participating in this. So be safe and strong, and we'll all come out of this together in the end. Thank you so much, and we're going to call it a day here. So
Thank you.
Thank
Stay
you.
healthy. Appreciate your time.
thank you for attending.